Take aim. Goals and priorities. You know, it's hard to draw up a roadmap without knowing where you currently are and what your financial destination is. Goal setting is absolutely crucial. It's time to take aim. When setting goals, your time horizon becomes very important. Time horizon and the price tag of your financial goals will influence how aggressive or conservative that you need to be with your money. We have short-term goals, medium-term goals, long-term goals, and even longer-term goals. Let me give you an example. Now, a short-term goal, usually less than 1 year, could be something like saving 6 months emergency reserve. A medium-term goal, which would be 1 to 5 years, might be to pay down my credit card balance. A long-term goal, 5 to 10 years, might be to buy a new home. Longer-term goals, that's 10 years and beyond, take early retirement. How many years will it take, and how much do I need to invest monthly to save $1 million? The left part of the chart illustrates different levels of monthly saving. Save $200, $300, $400, or $500 monthly. The top part of the chart represents time in years. Let's assume an average annual return on your money of 10% and that your federal and state tax rate totals at 31%, for example. Invest $200 monthly, get $1 million in 35 years and 9 months. Invest $300 a month, you'll be there in 32 years and 8 months. $400, 30 years and 4 months. $500, 28 years and 6 months. Determine what your future needs will be. Establish goals for the future. The people who are successful in life are the ones who have a clear vision of what they want to do and where they want to be. If you don't plan for yourself, you will always fit into someone else's plan. Investing 101, Practical Principles. One of the biggest factors why investing is so important is because of the effects of inflation. Inflation, or your cost of living going up, has averaged approximately 3.25% annualized. This is an average of the years when there was little to no inflation and periods of high inflation like the 70s and early 80s, where gas prices were over $2.50 a gallon in 1981. Your goal as an investor should be to outpace the rate of inflation. Inflation includes the cost of things like healthcare, groceries, and movie tickets. Now, I want you to think about your grandparents for a moment. If they're anything like mine, they have and will always complain about the way things used to cost compared to nowadays. That's inflation. And I'm going to give you some real-world examples. Did you know that in the 1980s, the average car cost was approximately $6,000? Nowadays, the average cost, $19,000. Let's talk about healthcare. A single day in the hospital would have cost you $350 in 1934. Today, the average cost for a day in the hospital would be over $3,000. You want your money to outgrow the rate of inflation. The chart below shows the average annual rates of return for stocks, bonds, and cash from 1926 to 2002. The average return for stocks at 10.2% drops to 6.94 when you factor in inflation. For bonds, the average return of 5.9 drops to 2.76. Finally, an average return for cash drops from 3.79 to 0.71%. This shows the dramatic effect of inflation on rates of return. One of the greatest concepts of investing is interest compounding. Compounding interest accelerates the growth of money. The interest is paid on previously earned interest and on the original principal. Let me give you an example. If I took $5,000 and it made 10% interest, that would equal $5,500. Now, if I take that $5,500, which includes the $500 of the 10% I previously made, I'll add another 10%, and that'll equal $6,050. I just earned 10% on the previous 10% interest and on the starting principal of $5,000. That's compounding. Now this chart shows the difference between me saving $125 a month for 1 year with no interest versus someone else who did the same monthly savings but got an annual interest of 8% that was compounded monthly. There's a big difference between the two. And this is a visual that really shows and hits home the point that compounding has a dramatic effect on the accumulation of your savings. How many years will it take for my money to double? If I take $500 and make a 10% rate of return, I'm going to take the number 72 and divide that by my 10% rate of return. That equals 7.2. 7.2 represents the number of years that it will take for my money to double. In this chart, you will see $500 grow by 10% a year. You can see that a little after year 7, actually 7.2 years, that the $500 is getting close to doubling in value. The earlier you start investing, the better. There's a significant difference in savings between people who start earlier and those who start later on in life. The investor who started at age 25 had a 10-year jump on the investor who waited until age 35.